Hello, everybody. Jeff Rivett here, Portfolio Manager with Creed Capital Management Group at National Bank Financial. A very happy November, very happy start to ski season. Opening weekend at Whistler coming up here. Black Friday just around the corner, and then into the busy Christmas season. So life's about to get hectic, and I wanted to get a quick update video out just to let you know what we've been up to in the portfolios. Now, of course, the big topic of the day has been the sort of a slide that we've seen in the market the last 4 weeks, specifically in some of the big U.S. tech names, and just the concerns about what's going to happen there, given just the tremendous increase that we've seen this year in the big tech space. Now, in our portfolio, exposure-wise, of course, we own Apple, we own Amazon, we own Microsoft, and we own Google in the U.S. portfolio. And then we also had exposure to both Tesla and Meta in the auto callable notes that came due in October. For those of you that participated in those notes, the returns were obviously very, very good over the year that we held them. And we'll be looking to replace those notes coming up with something similar, a broader investment in the NASDAQ 100, so in the 100 sort of largest growth companies in the US. That does give us a bit more diversification. It gives us a bit more breathing room out of the big tech space. But it also begs the question, well, what do we think of that space given sort of the pullbacks, given the concerns? Now, there's been a lot of parallels drawn between the current AI sort of bubble and the tech bubble that we saw in 2000. Now, my general feeling on bubbles or on blowups is that by nature, they're unpredictable, meaning that when everyone's expecting one, it would be atypical for there to actually be one. The biggest crashes that we've seen in the market, COVID being the last one, nobody expected that we would have a crash from that, and lo and behold, we did. Same thing with .com. There was even more greed than we're seeing now in the AI trade before we saw that blow up. So my feeling is that we're not quite done that yet. That we're going to see some continued growth in that space in the near term. And so we still want to make sure that we're participating, but we want to be careful. And so the auto callable notes, of course, for those who are familiar with them, they give us exposure to that area of the market with a downside cushion, with a buffer protection, and we trade off some of the upside in those names for the safety. And I think that that's a really good idea right now, given where the market is. In general, when I look at what portion of our U.S. equity is in those big U.S. tech names, we're about equally weighted to the market. So we're not making the call to be under or overexposed. But when you look at our overall equity, so how much equity we have in our portfolios, that's on the lighter end. So we have less U.S. equity than sort of the typical portfolio would have, and less Canadian equity as well. Now that's really important when you look at the performance this year, because I say it, I think probably every month, that our biggest goal is to maximize return for the least amount of risk. And when I look at our portfolio performance right now, the average balance fund in Canada as of yesterday, November the 20th, is up about 9% on the year, and that's without considering fees or anything. So about 9%. Our portfolio, our typical balance portfolio at Creed Capital, is outperforming that by over 1%, which is great. But then it begs the question: well, how do we do that? Did we take on excess risk, or how do you get that outperformance? Because it doesn't just come from nowhere. And when you actually compare the risk in our portfolio, the exposure we've had to equities, and just sort of the variability in our portfolio compared to the average balance fund in Canada, our risk our risk as measured by standard deviation is about 1/3 less. So we have outperformed the average balance fund in Canada significantly while taking on 1/3 less risk. And I am really, really happy about that. That is exactly our goal, because we always want to make sure that when we have those tail risk events that nobody does expect, that rock the portfolios, that we are going to be well prepared for that, and be well protected. And I feel like right now, given our equity exposure, that's exactly where we're at and where we have been, and yet we've been able to deliver above average returns to clients. So all in all, things are looking up, looking stable. And I will be back next month with a Christmas update. Until then, take care and have a great month. Bye bye.